as Radhika Gupta was telling me a little earlier, this is not a launch event, it's an after party. So I hope that you guys approach this discussion in that mood, because I'm going to involve you not at the end, right? So normally how do book discussions go? Moderator talks, authors talk, um, you guys typically zone out. Somewhere in between, you wake up, I say something interesting, and then you pay attention again. So we're going to tear up that rule book completely. All right, you guys are going to be part of the discussion right from the start, because the problems that the book addresses, the issues that the book addresses, are central to your lives. They are the things, the dilemmas that you wrestle with on a daily basis. Um, and so, what we're going to do is we're going to start with 4 different, um, you can say, asset classes, investments, and the debates around them. One thing that Radhika and Niranjan have done, apart from, by the way, explaining it in extremely simple terms, is not to take dogmatic positions on various debates, because finance is ultimately personal and it is full of ifs and buts. So it's perfectly valid if you have a different point of view. In fact, we'd love to hear different points of views. Okay, so in the meantime, I want you guys to think about the first question, okay? The first question for this evening, which is the most hotly debated question in finance, personal finance: real estate, rent or buy. They have addressed this in the book. We will come to that. We'll come to their answer. But I want to hear what you guys think about real estate. How do you approach it? So I think, yeah, we can pass my mic, because anyway, they will have to answer it. So just raise your hands. Unfortunately, the room is a bit dark, so I might not see you. But if you raise your hand for long enough, my gaze will wander to the right hand. Okay, so yeah, there's a mic coming to you.
So on rent versus buy, there's actually a very interesting story of my life, that when I was getting married, my husband does not have a house in Bombay. So, but my father was very insistent that my daughter will only get married if you buy a house.
In Bombay?
In Bombay. My husband is an investment banker. So being a banker, he created a very detailed Excel sheet on why it makes sense that on a net, your daughter would probably have little more money by investing that money rather than buying that house. So even we are renting, pay the rent, even then net we would be making money, so might as well, which is why we will go ahead and always rent, at least in Bombay. So somehow that Excel was really convincing, and since then it's been 6 years now and we are still in a rented apartment.
Fantastic. I, for one, applaud your decision. I had a similar choice because my work keeps me in Bombay, but I did the in-between thing and I went and bought in Pune, which is cheaper, and my hometown. But fully on board. Okay, other views, other questions? Please raise your hands and we'll get the mic to you. And if you're at the back, and if I don't see your hand, just make sure that the gentleman with the mic sees your hand so that he passes it.
Or you can just scream really loudly.
Or yeah, you can.
That also works.
Okay, how many for the buy over rent question? How many in favor of buying real estate? How many of you own, okay, let me just make it simple. How many of you own your houses? Practically, yeah, probably more than half.
Yeah.
So those who bought, can you tell us a little bit about when you bought, why you bought? So, okay, anyone who's bought for investing purposes, so to live in is a different decision. Okay, there's a hand there. Can we pass the mic, please?
So yes, I bought it for investment purpose, and this was way before I got married. The idea was that the rent that I'm going to get from that house is going to go to my parents, and that was the whole purpose of buying a house, so that they are not dependent on anyone, neither my brother nor me, and I co-own it with my mother. And of course the EMI is paid by me, but the rent is gained by my mother, which...
Okay, so a steady source of income. I'm just going to come to Radhika and Niranjan in a minute, but I'm going to tell you guys my story, or rather my family story with buying a home to rent. So my grandfather, he did well in his business in his day, and he managed to buy a building in Pune. and he rented out all of the flats in that building. And then they passed the Bombay Rent Control Act, and people were frozen at 200 rupees rent a month, which the tenants loved. And you could not evict people. You had to convince a court that you needed the flat for a legitimate purpose, for your own reasoning, for your own purpose. And so my parents spent their entire life in court filing eviction suits. So they had to repurchase a building that they should have inherited. And that affected my outlook towards real estate. But let me now come to Radhika and then Niranjan. You guys have a lovely formula for thinking about real estate, and any personal experiences that you guys would love to share.
So I want to tell you, firstly, thank you everyone for being here. It's just amazing to see everyone in this format, and it truly is not a launch, it's an after party. It's meant to be interactive, it's meant to be for everyone, it's meant to be fun, and thank you, Neil, for doing this. So I'll tell you two real estate stories because, as you said, we've really tried to be very middle path because I don't think there is any right or wrong answer. Now, I'm a finance professional and my husband's a finance professional. So theoretically, we should be like that investment banker husband of Shikha who lives in a spreadsheet. And there's nothing wrong with living in a spreadsheet. But we bought a house. After we sold our company to Edelweiss, actually the first thing we did when we were not poor entrepreneurs is like, Bombay mein ek ghar to hona chahiye. And we did all the spreadsheet analysis, and I can tell you, it made no sense. I mean, the rental yield on a home in Bombay is 2-3%, and FD gives you 6-7%. But there is also, and there are people who believe in that, and there is nothing wrong. But there's also something I told my husband, and I said, Nalin, you can't live in a spreadsheet for the rest of your life. And I truly believe a primary, and we've talked about this in the book, a primary home purchase is an emotional decision. And when it's emotional, then you don't do that comparison of rent mein 3% milega or bank mein 7% milega, but you have to recognize that it's truly emotional. Not only did we buy a house, in COVID we upgraded the house. So if it's a foolish decision, we've made it twice, but it's been an emotional one. Now the second story I'll tell you illustrates a little bit of the contrast, which we've also talked about, which is real estate that is not for primary consumption, which is for investment. Like many people, my mother-in-law inherited lots of small flats, one Pune mein ghar, one Bangalore mein ghar, etc., etc. I come from Delhi where people measure their net worth and success in flats. Like, wahan Okhla mein ek ghar hai, wahan ek commercial plot hai, I'm very successful. So that's, now it was great because the flats were paying rent, but as she's aged, one flat in Pune is completely crumbling. So we finally sold that after 6-7 years of my husband struggling. One flat in Bangalore, the tenant refuses to leave. So we can't sell that, and we've got a court case going, and we're trying to find a politician. If anyone's a politician in Bangalore, you can help us. But we're really struggling. Now, the little corpus we've sold with the Pune flat, we parked into, and this is not being brand ambassador for mutual fund, but we parked into more liquid investments. And that is at least giving her quarterly income. So the point I'm making is when you're looking at secondary homes, which are not investments, then you really have to look at real estate from the lens of investment. Then you have to have the banker spreadsheet argument.
A quick aside, which category mutual fund was it?
Equity savings, the most conservative, because she had never invested in stock markets. And you know, she was very, very nervous about it. So we picked something that was really safe, ready to get her started. And today she's the biggest brand ambassador of dumping your real estate and buying mutual funds. And I promise you it's not because of her daughter-in-law, it's because of her own experience. And we still have to evict that tenant.
Niranjan?
So, you know, when I moved to Mumbai, we, along with my wife, we decided that we'll never buy a house in Mumbai because, you know, they are at crazy rates. I already own a house in Pune, so there was no need. So for almost 8 years...
I think all Punekars stick to Pune, right?
Absolutely, absolutely. So almost 8 years, we never bought a house, but then I did a mistake just pre-COVID, and I bought a house. And after that, I bought another house. So being a cost accountant, being into finance for last 20 years, I ended up buying 3 houses. One of them was mistake, which I sold 2 years back and then bought a house which is closer to my office. But you know, the
Sorry,
thing is,
can we take a pause? Why was it a mistake?
So that's very interesting, and see, a lot of time we buy a house out of emotional decision that we need to own our own shelter, but we often fail to recognize that where is our office, how much time it will take to commute from there. So I bought a house in Borivali, my office is in BKC. It used to take almost 2.5 hours, and I realized, boss, this is a mistake which I have done. I would have stayed on rent, I would have shifted to a place closer to my office, but now I bought a house, we could not do anything. So finally we shifted there, stayed there for 2 years, and then we were just struggling to sell it. Somehow we sold it, and then finally bought a house which is now closer to BKC. In fact, that was more strategic decision because now it is centrally located. Pune is just 2.5 hours. But then it took me almost 3-4 years to realize I did one mistake, probably made a huge loss on if you put it on Excel, and then I realized. So it's when you do calculation, of course, real estate is not a great idea to buy, but you know, first house is definitely something which is an emotional decision you end up buying. But as Radhika mentioned, if you're buying for investment, then definitely it is not a wise choice.
Yeah. So you guys have a lovely formula to give people that how much is too much, when should you be buying, and you know what kind of EMIs to pay. Would you guys like to?
So, so for housing, we have a 30-33 formula. What we
Wait,
said.
let me make them guess. What is 30-33?
Yeah.
This is one relates to EMI.
Yeah.
One is your down payment, and the third. Any guesses?
Great. Yeah,
Not-
that's a great answer. So 30-33 is very simple. If you want to buy a house and you want to check your affordability, apart from other reasons that, you know, where you want to buy and all, first have at least 30% as down payment because that will ease a lot of your EMIs and all. The second 30 is basically to check, you know, how much EMI you can pay. So if your salary is X, not more than 30% of that should get into EMI. And last 3 is the overall affordability. Whatever is your annual income, the total house cost should not exceed 3 or 4x of your annual salary. That broadly brings you in a place where you are able to afford that house. You're not stretching too much. Your EMIs are within limit. Even if you end up doing any mistake like me, you can still manage it well.
And actually, you know, he makes, I mean, most people who do real estate worry that I'm stretching myself too much. That frame, the other mistake that we make with the real estate, and Rashesh told me this, is we underinvest in the kind of house we want. See, because a house is a decision you're not going to make every 2-3 years. And for many of us, income is also growing, Neil. So this also tells you how much, like we stretched when we bought a house, we really stretched. How much can you afford to stretch also? So it helps you find the balance.
Yeah, very true. I mean, I was just thinking, how many, if you take, what, 2 crores as the average flat cost in Bombay,
Yes.
1/3 of that means that's a CEO salary, right?
See, in Bombay, the formula is very difficult to be implemented, honestly. And
And I'm
that's where
silent on
Bombay
CEO
is
salary.
far away in terms of affordability, but it really works in a city like Pune, Hyderabad, Bangalore for that matter.
Absolutely. Okay, so the next question or asset we're going to turn to is gold. So I want to hear some voices around the room. If you bought gold, why and how? I think the how question is as interesting as the why question. And you should be proud of yourself, right? Because gold has rallied. So like I expect to see some hands up.
There is a gold here, there's
Okay.
a gold hand.
So generally what happens is like when people have businesses, so mostly in India, in businesses people don't get white money, people do get black money and there is no way out of it. So even if I tell my clients that I want, I'll be charging 18% GST, they say I don't want to get work done from you. So what you do with that cash? And the most easy way out is people buy gold, that's it. or maybe they buy a flat or something where they pay half of the amount to the builder, something like that. This is how it works, I feel.
Yeah, yeah. Although, has the ease of it gone down? Is it as easy nowadays to buy gold with? Okay, okay,
There are PAN card requirements, but it still happens.
It still happens.
okay. Can we pass the mic to her?
Hi, most of my family invests only in mutual funds, okay, and gold was seen as something that's not much of a returner. But I somehow, after while doing my CFA, was like, no, but it's a good asset class to diversify into. And we all have jewelry and all of that, but what I realized during COVID is having gold ETFs in my portfolio was the biggest boon, because it was the only thing that was in green. I could book profit, remove money, put it into equities, which doubled in 3 months, right? So gold is a good asset class to diversify into in really, really bad times like COVID.
Yeah, or the last year.
Yeah.
Okay. More hands? Yep, over there.
So I invested in gold like about I think 4 years back, and primarily for me the reason was diversification. Like most of my money was into equities, so this was more of diversification. The the way how I invested was sovereign gold bonds. Again, I think that was helpful for me because I was okay to invest for a period of 5 years. It was offering me tax benefits and the added advantage of 2.5% interest, and yeah, I think that has worked out well for me.
Yeah, absolutely. Although now they've stopped issuing SGBs.
Yeah, because
So,
it's,
what would you do now? How would you buy gold?
I think ETFs is a better option now because they've stopped, because the government has realized that it was kind of a mistake for them at least, and good for us. So yeah, I think ETFs is the way.
Yeah, absolutely. Everyone here knows what ETFs are. We are just assuming that folks know what ETFs are. If you do, just raise your hand, so then I won't dwell on the question. Okay, so yeah, most people don't seem to know. ETFs are a kind of mutual fund which invest in the underlying commodity, which in this case is gold. So they track the price of gold. It's a nice electronic way of buying gold. I'll leave it at that. There are sort of more things to know, but just do look it up. It's a nice, efficient way. Okay, I'll have one final hand and we'll turn to Radhika and Niranjan on gold. Oh, there we go. This side is quite active. Piche, yeah, like next I want the back benchers to answer.
And by the way, men are answering the gold questions. So this whole thing of like gold is a woman thing, like half the questions are being answered by men about gold.
So I've been an investor myself. Obviously, it's a great asset class and figured it's a good time to invest 3 years back or something. But I'm also an advocate of actually having a certain percentage of your wealth parked in physical gold and high value gemstones. I'm kind of a doomsday philosophist sometimes. So it also helps in if we go through a currency crisis or something like that, you need to have some sort of liquidity. Liquidity is one of the most important things in everyday life and in crisis. So some part of your wealth should always be allocated. So I got my family to also like buy a lot of physical gold when we had the money.
Yeah, I kind of get that. I also have this doomsday thing at the back of my mind. You should have something. But on the gemstones part, have you sort of struggled with the whole diamond price collapse, or it was not?
No. Got
Okay.
lucky. I have good jeweler friends who warned me like 7-8 years back, ये कोई lab grown diamond आ रहा है, prices crash हो रहे हैं. I'm like, okay.
So you didn't
stay
touch
away.
diamonds. Okay, hand in the.
Gold coming in. Yeah, I read it somewhere. There were 2-3 articles on it, and then I researched it. And though it hasn't been certified as yet, but when scientists were asked that this person who's made it, is this possible? They were like, yeah, it's very much possible.
Yeah. Who knows?
So that could be the
Same.
next one.
Okay, same point. Yeah, synthetic gold. So I think I also saw some pieces of content, but I'm more mistrustful of content unless There are lots of authorities backing it up, but it's still possible. I wouldn't rule it out. Okay. So, Radhika?
So I love jewelry. I'm from a typical Manya household where I think every birthday of mine or every occasion, my parents used to buy those little gold tablets. And then when I started earning, obviously I was buying gold and diamond jewelry. I am depressed by the value of my very expensive diamonds, and I did not sell them. But as I've gotten older, tried to make a distinction between jewelry and gold as an investment. And I think that you will see with me as a recurring theme, that what is for consumption is for consumption, and what is for investment is for investment. Of course, gold is there on a rainy day and you benefit from the price appreciation. I do believe in the times we live in, while physical is good, storage has its own challenges. So I absolutely agree with her that if you have to do this for investment, then in the old days, the sovereign gold bond, now the index fund or ETF route just seems like a low headache way to get gold exposure. I was more skeptical, honestly, about gold when I started investing as a part of my portfolio, but I've become a big believer. I do believe in a crisis, gold shows up and plays the hero. We saw it last year, we saw it in 2008. I think investors do a slightly bad job of when to buy gold and when not to. So they forget gold in the good times because it doesn't make as much money as the stock market. And then in the bad time, they're like, oh gold, oh gold. So I've concluded, at least personally, I just want to have a static amount of gold in what I do.
So gold, there are two ways to look at it. Of course, you cannot replace investment in gold with physical gold, because that is very personal to all the women out here. So let's not touch that area. And it will always be, because it has also helped many households come out of crisis in India, and it still is a resort for the last this thing. But when it comes to investing, definitely gold does make a lot of sense in your portfolio. Now, in which form you make that investment is very important. If you see, physical gold is not an investment, because straight away you lose out almost 7 to 8% for making charges, for GST, for when you buy and sell, the rates are different. You straight away, if you're buying a physical jewelry for investment, straight away you're at an 8% loss the moment you're buying. Now when you get into an investment like ETFs, sovereign gold bonds are no more there, but ETF is the only option. I think so. It does make sense. Beyond that 8%, it also gives you a lot of liquidity to rejig your portfolio. So I think so. It has two ways to be in your portfolio. One is your emotional need, consumption need, and one is investment. I think so. 10 to 20% of your portfolio should be investments into gold. And when I say investment in the form of ETFs and all, jewelry doesn't count there.
Now I'm going to turn to the third asset or question, which is fixed income, right? So we heard some time ago about rent being a nice fixed stream of income for retirement, but there is also FDs at the very basic level. There are bonds, there are debt funds, one of which Radhika is very famous for. So again, curious to hear your experiences. How do you guys invest in fixed income and backbenchers this time, please? We're going to station somebody at the back so that you are nudged to
Find someone at the back.
Yeah, or arbitrarily point to people at the back.
I'm sure between PPF, Dakana, all the traditional stuff, everybody in this room has some form of fixed income.
Yes.
Even the bank account counts as fixed income.
True. Although 2.5% is
Bad fixed income.
It's bad fixed income.
somebody at the back. Would you guys like to tell us? Just share. There's no right or wrong answer, right? Nobody's going to judge you.
Nobody's going to judge you.
I guess with the change in taxation, the love for debt has
There's
come
one
down.
at the front. You can
Okay,
take one from
up front.
I've moved from trusting only FTs to mutual funds over the last year, and gold as well. So that's been, it seemed difficult at first to make that decision, but now I feel more comfortable with it. For me, the question now is, how can one also build wealth thinking not of only like one's own future, but also in terms of the causes that one wants to support. And as a single person who's not thinking of a child, what is it that one wants to give back to society, and how can investment be guided by that? I don't find answers to that in most spaces that talk about investment, because it's typically fear driven. You are going to fall sick, you're going to die, you have to think of your children, what do you want to do? So yeah, that's something I'm keen to hear about.
That's interesting. I think in the financial world, we cater strongly to selfishness. We think altruism doesn't exist, and I think I'm glad that you're one of the few people who are proving it wrong. So, Radhika, do you want to take that up?
Oh, the second question on altruism or the fixed income question? Both.
Both?
No, look, I think it brings me to a broader point, and this second page of this book has a quote, which is the Mango Millionaire's wisdom, which says that money can't buy happiness, right? There's this whole thing of, can money buy happiness? I don't think money can buy happiness, right? It can only buy the ingredients for the happiness. And so we've honestly, very humbly started the book by saying that happiness comes from a lot of other things. It comes from purpose, it comes from doing meaningful work, it comes, in my world, from meaningful impact, whatever that may mean for you. It comes from, I mean, Niranjan's whole family is here for his first book, After Party. I'm sure you can't measure that kind of thing in words. So despite selling mutual funds for a living, I must tell you, finally, an NAV should never give anyone happiness. An NAV is just a route to fulfill goals that give people happiness.
Well said. All right. Anybody else would like to weigh in on fixed income or bonds? Yep, sir. Can we pass?
I think fixed income is very nice. One should have fixed income. I would rather prefer in commercial rental. That makes more sense than residential rental, because the returns are definitely double in India, right? But I have a question for the panel. In debt, we have ultra short, liquid, and short term. It's very, very confusing, right? Because 3 months, 6 months, 9 months, what exactly we need to offer customers? I'm an MFD. So, right, what do we offer to customers? Short, ultra short, short, liquid. So, that's really confusing.
I'm going to make a comment and then Niranjan will answer. Yes, I agree with you. Our mutual fund categories in debt are extremely confusing, and I apologize. I wish I could change this. Now you will simplify for them, but I truly believe in the fixed income category, we have FD, we have so many options, and then we have 30 options. So we do make it confusing, but we can simplify. The book does, and Niranjan will right now.
So, great question. And actually, at Edelweiss, we tried to simplify this by launching target maturity funds. Because, see, in fixed income, a lot of Indians have that experience that if I want to invest for 1 year, 1 साल की FD है, 3 साल के लिए करना है, 3 साल की FD है, which is very confusing to decide in an open-ended structure. Because, as you said, sir, ultra short term, I don't know how much period I want to invest for in this fund. A long duration fund, I don't know how much time I should invest. And that's where target maturity funds fits the bill. You know you want to invest for 1 year, go for that 1 year maturity. If you want to invest for 5 years, go for 5 years. So that is one place. If at all you want to simplify the ultra short term jungle, one simple rule to invest in debt is you know what is the time horizon that you want to invest. If you want to invest for a year, go for a fund whose average maturity, I'm not getting into duration and all, average maturity of the portfolio is 1 year. That is one simple rule which simplifies selection of debt mutual funds for you.
All right. We'll now move to equity, everyone's favorite asset class, I'm sure, especially over the last 5 years. Any experiences to share? Do you invest directly in stocks or mutual funds? How has that been? Is it as confusing as debt? Yeah, please do.
If you made a lot of money, you can just make us jealous and say that.
Yeah,
No,
yeah.
That's also cool.
So I've been investing in equity mutual funds and equities since the age of, I think, 20. So it's been a really long run. But what I have to say is equity mutual funds did buy me happiness. They did buy me happiness. I know it was an ingredient to it, but they did buy me happiness because it gave me the financial freedom and security to get out of a very dark place. Without that, without having that standing, that financial stability, that financial security, I couldn't have been in a much happier place. So it is the exit route to a lot of unhappy situations and circumstances.
Yeah, it gives you financial freedom ultimately.
Ultimately it does,
Yeah.
yeah.
That's beautiful.
Yeah. Okay, at the back.
So equity, a very interesting journey for me. So I am a CA CFA, but I have to tell you this. When I started off with my first job, obviously the lure of direct stock investing was there. But having struggled, to be very honest, being struggled with it, looking at how the markets are performing, I'm referring to 2013, 14, everyone wants to participate in that run, right? But what I've really figured is, I think I had a terrible portfolio. When overall returns, when I would see versus what, say, the market is giving overall, I said, why am I even getting into all of these things where I probably at that point in time did not have my expertise. Even, of course, I started off and I moved on to a mutual fund career. Even then, I would say I was not very great with my equity, choosing different equity mutual funds. What has really paid off is, for me, has been my consistency. I do not like to see money in my bank account at any point, no matter what the market environment. I have even been a debt investor, debt fund investor, I've been a hybrid fund investor as well. I just do not want to see any money in my savings bank account. This is what is something that is, very clearly, I'm wired around that. That has really paid off. It has paid off for some of my holidays, though I try that I do not spend beyond on holidays, beyond my salaries, but it has really, my equity mutual funds, I would say, or overall fund portfolio has really paid off for my holidays, and that's what my journey has been.
What is your most successful fund pick?
So, see, most successful, I would, see, we have a mid-cap momentum fund. I think that when I see its journey, I think it's very thrilling. Trust me, it's thrilling on both ways, of course, by the nature of the fund. That has been, but I would say as a journey, I have also looked at certain hybrid funds, which helped me through certain phases when I would see how the market is performing versus, say, my balanced advantage fund. I was quite happy. So, while overall returns, you would say that a fund which really runs up really fast would add up to your portfolio. But as a journey, something that would let me sleep at night, I think the hybrid funds do it really well for me.
Okay. Anyone else? Equity journey? Good picks, bad picks.
Thank you for letting me speak again. But yeah, for me, it's very personal, a vulnerable story also. I have seen both sides of equity really badly and really nicely. So my dad dabbled in futures and options in early 2000s, lost a ton of money, family entered debt, right? So mom has been the pillar, and then she kept investing like 2,000 SIPs that she made us feel, listen, if you need something any day, I think something is building here. And then both my brother and I, we have built our careers in finance. I worked for a prop hedge fund for 12 years, paid down by equity investing, being that employee, earning bonuses through equities, paying down the loans. My personal portfolio is pretty average, but at least in the fund I did incredibly well. So I've seen two very big extremes, and now with my own thing, I'm also trying to help people understand, like, you don't know what bad things are in equities. So you need to understand why you're doing a certain type of investment. So yeah, that's been my experience with equities as well.
Yeah, thanks for sharing that. It just reminded me, there was this video of a Uber driver. I don't know if you guys have seen it. It was taken by an ED journalist, and basically he was saying कि मैं साल का 1.5 लाख कमाता हूँ, and उसी साल में he had made a 1.5 lakh ka loss. Like his entire earning had been wiped out through F&O. And this story's been playing out up and down the country. So it's a very real issue for a lot of us. All right, Radhika.
Equity journey has been interesting. So, I actually remember in the early 90s, and some people, if they want to admit that all will remember this. But I remember my father collecting physical share certificates, as many of us did, and he was big into buying individual stocks. But to be frank, like many people at that time, I always thought share market means satta bazaar. And it is, you know, I think things were not as transparent, the world was physical. I think today's world is very different because you are almost seeing these companies being built in front of your eyes, listing, you're seeing these journeys. So the equity journey, and again we talk about this in the book, feels a lot more concrete. You're not buying mutual funds or equity, you're buying businesses. And you know, now as someone, so my starting was that. Then when I got my first few salaries in the US, like you, I've actually made extreme mistakes. So I started by investing all the money I had earned in the last 3 years into equity at the peak of the bull market in 2007. And you can imagine how well that went for me in 2008. And I learned my lesson the hard way. And I learned that you should invest the amount of money that you are comfortable with in equity, because equity can also go through that crisis. And incidentally, when I came back to India, I had to withdraw a lot of that money at cut NAVs to start the business. So that was my first dose of the journey. I also learned that me and my husband both have careers that are very strongly linked to the equity market, so we may want to tone down. Then after that, entrepreneurs started in SIP, became conservative, did equity, but didn't do equity the whole hog, did it through balanced funds, mix of equity and debt, got comfortable, gradually increased my SIP. We bought the house. As we paid down the home loan, I calibrated and took up risk. So made the mistake, recalibrated, and now I want to invest in equity. I want to do it in the right amount, and I want to do it in a sensible way. And like Shikha, I absolutely hate seeing money in my bank account. In fact, I get nervous with it. I keep telling my husband, why do I have so much money in my bank account? And I take tremendous pride, because I'm a salaried person, in the monthly SIP number I do. So since I've started investing, the monthly SIP I've done from 2011 to present, and I've never said this, has gone up 80 times, just the amount I've done in a monthly SIP. And I have a target that I want to get it to this next year. And my husband and I, we get competitive about it, and we discuss targets. So I don't like money in my bank account, and I get very competitive. I think it's my Delhi property person. Like, आपके पास इतनी property है, मेरे पास इतने की SIP book है.
So, you know, my equity journey started like any other investor today who has started his journey, thinking that equity is to make quick money, right? Get overnight wealthy and all. I started my equity journey when I was in Sher Khan, 2005. From Sher Khan to ICC Securities, then started my mutual fund journey in 2008. All through this, I used to do F&O trading.
2008 top or bottom?
Both. So I was lucky in 2008, by the way, but all through till 2010, I used to do margin trading, day trading, using leverage, F&O, everything. But fortunately, because I was into mutual funds and all, there was half of my money going into SIPs as well. I started my first SIP in 2006, which I used when I got married in 2012. All of it. So the crux is I also started, you know, with a lot of mistakes. Fortunately, I was in the industry, so parallelly I also built another portfolio which helped me. But over the time, I realized the way to look at equity investing is, if you're able to sleep at night, what Shikha mentioned, if you're able to sleep at night, you have comfortable equity exposure, you have the right equity product in your portfolio. If every day you wake up and you are forced to look at market, you're doing something wrong in your equity portfolio.
Are you guys allowed to say your favorite mutual fund?
Sorry?
Are you allowed to say your favorite mutual?
Yeah, absolutely, absolutely. So see, for me and my wife Sharvari both invest. For her, it has been balanced advantage fund, because I don't want to take risk with her money and with her scoldings. For me, it has been a mid cap fund, be it on the index side or active fund or on the active side. Edelweiss mid cap definitely has been one of my favorite fund. because I was with ICICI Value Discovery is one fund where I've been doing SIP for last 16 years.
Classic. Radhika?
I will say only Edelweiss funds because I should. But it's evolved. I think for a lot of the family that's conservative, the balanced advantage funds, even for me when I restarted my equity journey, the equity savings fund for my mother-in-law has just been amazing. It's given her so much comfort. You know, she now uses it to withdraw quarterly money from her profits to go on these holidays. And I was telling you this, once her friend asked her that, are your sons funding all your holidays? She's like, no, my equity savings fund is funding my holidays. So I think that. For my son, I've got much more aggressive funds. So my 3-year-old son who's not here, he has an equity portfolio. So he has things like mid-cap fund and small-cap fund because for him, we are really hoping that we are investing for 15, 18 years. So those have been great also.
So I'll tell you my favorite Edelweiss fund, because I'm going to be nice to them, which is the Greater China one.
Oh, yeah.
It's one of the few overseas funds that are still open, and returns have been pretty spectacular if you've timed it right.
Yeah.
All right, and now I'm going to just finish off with 2 issues which are not assets, they are sort of broader questions in finance, and then we will open it up. So you can ask your out of syllabus questions. So the syllabus ends after these last 2 issues. So the first of them is insurance. I think 99% of the discussion on insurance tends to be negative online for various reasons. So if you do want to share a pain point or a bad experience, that's fine. They have a very nice formula for figuring out how much you should take in terms of life insurance and I think even health insurance. But before that, can we hear some experiences with insurance? And then mutual fund guys, so for them, I mean, you can say whatever about insurance, right? Koi farak nahi padta. हाँ, मतलब it's not an insurance company, right? So it shouldn't be an issue. All right, so any experiences with insurance? If not, we're going to pick on Kazad and ask him.
Kazad's smile is saying more than it should. By the way, I'm on the board of our life insurance company. Oops.
Oops.
But you can say whatever you want.
Okay, let me just do a quick poll. So let's start with life. How many of you have term insurance? Show of hands, right? Most people in the room. How many of you have your own health insurance policy, right? Oh, that's fantastic, right? Most hands going up in the room. How many of you have more than a 10 lakh health insurance policy? Again, fantastic. I mean, the awareness on health insurance has, I think, really gone up since the pandemic. But there are strategies that you can employ to get very high cover at a relatively low premium, and the same with life. So Niranjan, if we can start with you.
So in life insurance, basically, as you know, everyone says you have to keep insurance and investing very, very separate. How much insurance is, I mean, see, a lot of, we look at the numbers, the penetration on numbers in India, it's roughly around 5-6%. But if you see out of that 5%, 95% of them are underinsured. So if you see the adequately insured numbers in India, it won't be more than 1% of an entire population. So how much insurance becomes very, very critical. We have given a simple calculation, and because that number is personal to everyone, you just have to do that calculation. In fact, we have given a very basic calculator on mangomillionaire.in. You can go there. But how it goes is, first, what is your annual expenses? And if you're not there, at least 25, 30 years, your family would need that money. Add maybe 6% inflation on that. That is your first number. Second is goals, whether it is your children education or any other fixed expense that you will incur over the next maybe 20, 30 years, add that amount. If you have liabilities, which is very important, if you have loans, add that amount. That is the entire number. That is the net number that you need as a sum assured. And in most cases, if you calculate it this way, I am dead sure 95% of people who already have insurance would be underinsured. The second thing very important to note is when you start your career, you calculate this amount would be much lower, right? As you age, as you go in 35s or 40s, this amount will increase. So even if you find this amount to be 1.5 to 2 crores, it is always better to get another 1 crore or 1.5 crore, because if you recalculate this amount after 5 years in your life stage, it is going to increase. So always have that buffer, keep adding insurance, but this is something which you should calculate and see where you stand in terms of in terms of your sum assured.
So this is life,
Yeah,
health.
I mean, I'll make a quick point on life and then talk a little bit about health. Look, I know that people have had their frustrating experiences with insurance, and you read the reports and the mis-selling, and my friendly person came and gave me an insurance policy. I've seen it happen to my own parents, right? I think the challenge with insurance is we don't know what we are seeking out of the insurance policy, and it is very, very important to know what you are seeking. I agree with him, investment should not be what you are seeking out of it. And if you are seeking life cover, please read all the terms and conditions and get the insurance you need, not the insurance that is being sold to you. I think that is very important. On health, and we had an interesting and unfortunate incident in the family. I actually think the health insurance market has meaningfully improved in India. And many of us have avoided health insurance, I feel, because we came from backgrounds where parents worked in public sector jobs. Like my dad works for Government of India. He and my mom have full health cover. Many people are central government employees, state government. So it was taken care of for you. And healthcare costs were not that high. Today they are. Now, for one of my aunts, we bought an insurance policy, to your point, where you could pay 3 years of the amount upfront. And I think it tripled the coverage. We did this, and then she was diagnosed with some very, very painful disease. And actually, the insurance covered everything for her in a reasonably cashless way. So in the book, we've also talked about different kinds of insurance, critical care, top-ups, family, that you can use to make this work for you.
In health insurance, what is another important point to note is start early and continue that. Because if you break it, a lot of lifestyle diseases are catching up in 30s and all. If you break it, these won't be covered. In fact, for many people, it is very hard to get a health insurance because they have some or the other lifestyle disease, especially if you're in profession where you're sitting in office and all. So start early, continue the same insurance, don't break it. And another thing is go for top-ups, go for super top-ups. That will actually reduce the burden of your premium, plus you will have a larger cover.
Yeah, that's quite a smart strategy, because I've seen people getting 1 crore base plus super top-up, and the premium is quite manageable, under 20,000 in some cases. Okay, last discussion point for the evening, and high on the controversial element of it, which is mutual funds, direct or regular. So how many of you do direct plans? Let's show of hands. That's a good 20-30% of, yeah.
Which is the case.
Yeah.
Which is actually the industry case.
So, your respective thoughts.
Look, again, I want to be reasonably middle path on this, but I'm not as middle path on this. And I know you've written a lot on this topic too, Neil, but I think people have a misconstrued notion of what a financial advisor does. And that is a source of problem for people. I am not saying doing direct plans is bad. I think there are some very, very smart people out there who have the time to select mutual funds. And if you do, by all means do them. I know a lot of people who do them. But I think I would evaluate both options carefully. And I'll tell you another story. In my family, we had someone pass away, and the family portfolio had to be restructured and everything. And so they came to me and said, oh, we have a mutual fund CEO in the family. Why don't you just handle it? And I was like, well, because you have a mutual fund CEO in the family, I'm going to tell you, please hand this over to an advisor, because I can come in once a year and give you gyan, but really for a lot of people, the solutions are highly personalized. They need constant tweaking. year after year, often quarter after quarter. Like this person was dealing with the loss of income. At some point they needed quarterly income, then they needed to give it back. There were multiple family members, there was trust, there were wills that need to be created. And actually I gave them a financial advisor because they had no bandwidth to handle this themselves. So I think it's about expertise and bandwidth. There's no right answer. But if you're employing a financial advisor, know that their primary job is not picking funds for you.
So, if you can give time, understand things in a much better way, there's no harm going direct. But the cost of going wrong is very, very high. Imagine a difference between a diversified fund return and maybe a thematic fund or a small cap or a mid cap is over a 10-year period is more than 8 to 9%. Now, if you're trying to save that 1.5%, and if you're getting into the wrong category of fund, you are losing out on that 8-9%. So the cost is very, very high. If you can't give time, if you're just starting, always better to have someone by your side. Yes, that space is also something which you need to pick very wisely, but start with someone by your side. Over a period of time, invest in learning about it and then maybe probably go direct.
All right, so we're done with the syllabus part of this evening. I'm going to throw it open now. People often think when they come to book discussions that it has to be about the book. No, I've checked explicitly with both of them.
Yeah.
It can be about anything. Radhika wears many hats, everything from Shark Tank to mutual fund CEO to author. So by all means ask
So finally,
her.
I'm just going to give Shark Tank gossip, okay?
So just raise your hands. This is the last chance you'll get to ask her. Please do.
Radhika actually is a, very a lady who encourages youth, because when we talk to people, when we talk to our industry people, she motivates. So that is really fantastic, and not many people open up, right? She opens up on mental health challenges and many things which is a taboo. It's still a taboo, which is fabulous. So I really like that. Yeah.
Thank you.
All right. First the lady and then gentleman.
So I want to ask, how did you come up with the title of the book, Mango Millionaire?
Yeah, so for those who've read it, you'll see why, but we didn't want to call the book like Money Matter, with no offense to any of these books, I don't even know if they're titles, like Stock Market Wizards or Money Matters or anything like that, because, we just wanted it to be fun and different. And then, have you seen this movie Love Aajkal? Okay, so I'm a really filmy person, person. So basically, Saif Ali Khan had this whole dialogue about, where he tells Deepika at the end, we are the mango people, we are the aam janta, और हम जिंदगी में हीर रांझा और लैला मजनू नहीं बनना चाहते जो प्यार में कुर्बान टाइप्स हो जाएं. And I was like, yeah, this is a pretty relevant thing, because even in investing, everyone doesn't want to become Jhunjhunwala and Buffett and spend all their time, analyzing stocks. A lot of people just want to use their money to live a happy life, right? So, hence, why not Mango Millionaire? And then he said the title worked, and he's younger than me, and he said it sounded young. So, and then Pan Macmillan liked it, and so it all kind of fit together. So, hence, Mango Millionaire, money for the Aam Janta, not Aam Aadmi and Aurat.
All right, Chintan. Yeah, can we pass the mic?
I have two questions. One is, with the absence of marriage equality in India, security that often comes for heterosexual people from a partner and from a family is absent. So how can financial literacy help in that area to secure, to find security in ways that are traditionally not available? That's one. The other is, what are your thoughts on doing a version of this book for children and young adults? Because going by the kind of economy that we have, money is not going to be only through earning, but through saving. So how does one equip younger people with that knowledge, especially when they know that their education might not be the security that they are looking for?
Yeah, so I can take that in Niranjan ad. We actually On both questions, at the end of the book, we have a chapter on money and family. I think on your first question, I do agree, particularly for women. I mean, I've been a big advocate that, and it's true, even, it's not only true for women. I mean, earlier retirees thought that your children was your retirement policy. I don't think that's true anymore. I don't think your husband, father, children, anyone is your retirement plan or your security plan. I think Atmanirbharta is a pretty good word that FM invented. And I think it truly applies to money. So I hope that one of the objectives of this book is to make this so simple and accessible to common people that they don't feel scared to pick a bunch of mutual funds. And I really believe literacy can do wonders. On children, I think this book is targeted at people, I think an 11th grader today can read and handle this book. And certainly, I would hope that a lot of college students, before they start earning, read the book so that they don't fall for futures and options or do some of the stupid mistakes that both of us have done. We also talk about how to educate children on money and money values. Both of us have young children. Niranjan's are here, mine is 3 years old. But we're already having those conversations with children, and maybe the Pan Mac guys will make this an illustrated storybook that I can give to my 5-year-old, but you know, that's for them. We also hope to make this book widely accessible in more languages, but that I'll leave them for them to announce.
So on children, so in one of the chapters we have actually mentioned that, you know, money should be a dining table conversation. While the book can help, but it starts when we start having those money conversation with our family on dinner table, then the interest will rise. And I think so this book or many other books, children can learn. In fact, I was surprised, a lot of my colleagues and my friends, they have given this book to their maybe 11-year-old daughter, 12-year-old son. While they may not understand the technicalities of it, but at least they will start learning what is money. At least for the first few chapters, talks very simply about what is money in life actually.
And actually, Niranjan, I think we underestimate young kids. I mean, I remember in my Shark Tank stint, you know, one of the largest contingencies of Shark Tank watchers is kids who are 9, 10, and 11 years old. Now, these are people who are learning what equity is on national television, right? And I'm told some of them are coming and bargaining with their parents on what equity is after learning it. So these are people who have exposure to business, to companies, to equity, to stake, very young. So I don't think we're doing anything that's very complicated. I actually think we underestimate 12-year-olds. I'm hoping your daughter reads this book.
In fact, you know, me and my daughter used to watch Shark Tank and she used to, "Arey, deal done," and all those words.
Oh, yeah.
So I think so the culture is changing very soon.
One last question, then we can
One last question.
proceed for dinner.
I think there's like one at the back,
Okay, one at the back.
since you wanted people at the back.
Oh yes.
Hi. So what is the underlying math for the arriving at the formula of 30-33?
Niranjan?
Sorry?
The underlying math for the 30-33 formula.
So underlying math is very simple. So 30% down payment and 30% EMI. There is a math in that. If you see, let's take your, your annual income is say around 25 lakhs. Maximum loan amount you can go up to is 75 lakhs. Out of 75 lakhs, if you pay 30% upfront, which comes to roughly around 21, 22 lakh, the remaining amount, the EMI roughly comes to 30% of your net salary up to 20 years. So that's the math. The entire math is done in such a way that you are not overburdened with the EMIs, because I mean 100 out of 100 people buy home on loans. So the biggest decision maker while buying a loan, apart from location, which builder to go with, is how much EMI you should pay and how much debt burden you should take.
All right. Any final 3 takeaways that people can take with the book?
So with the book, see, the book is written, what we thought initially, that we should write a book where people can keep referring it to when they need. So when you're, trying to buy a home loan, you can refer to the home loan chapter. When you're trying to understand about mutual fund, you can go back. So it's basically a guide which you can keep referring to. It's not a one-time read because it's very difficult to grasp everything in that book in one go and actually use it. So we want to make this book as a habit, and whatever formulas or whatever it is as a habit in your daily money life.
All right, Radhika.
Well, since you said three, I would say three things. One is for younger people, saving is not that hard. If you automate it, you will get into a mindset, develop the good habits, don't take bad debt, you'll figure out your saving journey. Second is risk is not a bad word. We talk about risk well before we talk about making any kind of money. And this is my favorite analogy in the book. Risk is like going to an amusement park. There are all kinds of rides. You choose if you're comfortable with the roller coaster or a carousel. Don't throw up, don't get bored, but take some risk, take the right amount of risk. And third is, and since we're coming up on dinner time, this is really about building your own thali. It's about building a portfolio that works for your diet, using all the little foods that are out there in the market. But it's about building a thali that works for you.
Splendid. On that note, thank you both so much.
Thank you.
Thank you.
And to the audience for listening to us and also engaging. Thank you so much.